Hello, everyone, and thank you for joining us for today's webinar on investment transactions in India, opportunities and key considerations for European investors. So the economic slowdown brought on by the COVID-19 outbreak has forced businesses globally to pause and reflect on their sustainability as well as growth plans. Despite being immensely challenging, these times present companies with an opportunity to reinvent their strategies and tap into new growth avenues through alliances and acquisitions. The inorganic route, however, makes it imperative to first assess the market dynamics and the intricacies involved in successfully executing a transaction. In this context, EBG Federation and the Indo-Italian Chamber of Commerce and Industry, IICCI, along with Nextime, SKP and Corp Legal, welcome you in this discussion about the transactions landscape in India, its future potential, and the impact of the pandemic on deal making. After the webinar, we will share a feedback survey link for the same. Joining us for the discussion today are Antonio Fasano, Claudio Maffiletti, Tanveer Shirolkar, and Thomas Sasse. Antonio is a national board member of European Business Group, EBG, Federation India, which is a policy advocacy organization representing the European community in India. He is also the managing director of Relations at Work, India Advisory Private Limited, which manages European companies investing. He has also worked with ABN AMRO Bank and the Royal Bank of Scotland in London and Milan in the past. Claudio is the CEO and Secretary General of IICCI since August 2015. Prior to this, he was a General Services Manager at the Institute for International Political Studies, Milan, Italy, a research center devoted to the study of geopolitical and international relations. His main task at IICCI is to revise the IICCI Strategic Vision 2015 to 2020, focusing on activities such as execution of cluster projects in strategic sectors, reorganizing the communications and IICCI corporate branding, business development and marketing strategies for IICCI members interested in developing their market in India and in Italy, and most importantly, fundraising and project financing. Tanveer is a practicing chartered accountant with over 13 years of experience in transaction advisory. His core competencies include financial due diligence, valuations, mergers and acquisitions, transaction structuring, and deal documentation. His experience in advisory spans over diversified sectors like automotive, pharma, real estate, and among others. He has handled complex due diligence and valuation assignments, which include valuations of largest e-commerce companies of India. He has also had a brief stint at Landmark Group Dubai and handled investments into retail and hospitality sector. Thomas is a partner in Corp Legal Munich and leads the India desk. Thomas has a vast business experience in India since 1993 and has also lived and worked in Mumbai for 3 years as a director of a major German company. His core competencies include international commercial and corporate law, arbitration, M&A, finance and funding, asset management, and compliance. Before we begin, kindly note that all our listeners are in listen-only mode. If you have any questions, please share them with us through the question box on the right-hand side of your screen, and we will address your queries at the end of the webinar. Without any further delay, we shall start the webinar. Over to you, Antonio.
Hello, hi to everyone. I will say good evening to our Indian participants and good afternoon to the European ones. Briefly, I'm going to speak about the European Business Group and why for us it's important, and I'm very happy to be part of the organizing team of this event. European Business Group is an organization in India, which is composed by European companies only. It's a kind of, as you correctly say before, a lobbying organization made by European companies, strongly supported and endorsed by the EU delegation. So we have here an organization where a part of it are only and exclusively European companies, and technically I would say companies which are have Indian entity incorporated here, they may be also joint venture, but at least with 51% of shareholding in the hands of the European shareholder. So initially, the organization has always been here in India with the intent of supporting the European business, with a view of from companies which are here already based out of India. We have as an organization, our main activities organized and divided among the members, divided in position paper. So basically, it's an elaborate organization which has internally different 18 sector committees, which basically allowed us to have 18 different agenda where European companies gather together and they make throughout the year a position paper, which is then organized in a global position paper, which is really a set of advices that we as a European companies give to the Indian government. The interaction with the government is very proactive and effective. We normally are, as an organization, invited by the union government at the time of the budget to have our own interaction with them. Of course, then also on the local level with the local government, based on the different need, we activate contacts with the political world about that. But in the end, the main activity organization is the creation of this position paper and the interaction with the government. Now, very honestly, the difference, we as an organization do not act in a very active mode in really, I would say, bringing and helping a European company in setting up a base here in EBG is done by companies which are already here, either if they come through M&A or greenfield or investment joint venture. The reason is very simple, that of course M&A is a part of broader set of let's say FDI, the foreign direct investment, which in a part can be through M&A deals, but of course you have at the same time companies here with joint venture or with greenfield activities for the ones which they decided to come alone, setting up a base, a factory, or also a commercial entity over here. As the EBG, we work in India and we interact with the government on like supporting the European presence over here. And this is where it's for us it's very important, this seminar, because we talk about investment environment of India, how European companies which are based over here find it let's say feasible or not to drive through, I would say, the complexity of the Indian market. And here is also why for us it's important that the cut that we would like to bring to the seminar of really an insider point of view, because I would say that this is for me and also for the other panelists as well. We are, all of us have relevant experience here in India. Therefore, I do hope that the interaction we will have will be based on, of course, like the real experiences, problems that we can face, where also operation and transaction are done. Sometimes they fail for several reasons and so on. I mean, I will be very interesting in listening the rest of the interventions as well as like the questions. I don't want to take much time and give the time to the next panelist. I'm very happy on behalf of EBG to organize and be part of this webinar, and we do look for questions from the audience. I will now pass the word to Claudio for his presentation.
Thank you indeed, Antonio. Very good evening to all the attendants to this webinar. It is indeed a pleasure for me and for the chamber to collaborate with EBG, NextDig, and the other partners of this initiative. It's it is very important and very useful for both us and also people who attend to have such kind of interaction, which, as Antonio pointed out, delve into the operational complexities of working in India, or thinking of working and investing in the Indian market. My presentation will be composed of a few slides in which I will highlight a few elements of a survey that we have initiated in 2018 in collaboration with PricewaterhouseCoopers to map the presence of Italian companies in India. Before doing so, just a couple of words to explain what the Indo-Italian Chamber of Commerce is, what kind of organization we are, and what we do. We are an association of companies, pretty much like EBG. We focus almost exclusively on Italian companies and Indian companies as our members. We have a membership base of approximately 1,100 members. 85% are Indian companies. When I say Indian companies, I mean Indian importers, distributors, and retailers of Italian products or brands or technologies, but also Indo-Italian joint ventures and Indian subsidiaries of Italian companies. We were established in 1966, so we are 54 years old. We have our head office in Mumbai and regional offices in Delhi, Calcutta, Chennai, and Bangalore. As I was saying, and as I was pointed out during the introduction, our chamber works on what we call cluster projects. We have identified some sectors in which there is a high demand from the Indian side, in which Italy has a lot to say, both in terms of brand value, technology, and know-how, but where there is somehow a gap, where there is a need for an institution like ours to act as a bridge between the two ends of the two countries. These sectors are infrastructure, construction, and building materials, furniture and design, education, agri-industry, the entire agri-food value chain. So from agricultural machinery to food packaging, and we can put in the middle also food processing and cold chain. We call them clusters because we work on a multi-stakeholder approach. So we work with both Indian and Italian companies. We work with both Indian and Italian associations and institutions, bringing them together, trying to answer to the different needs of each and every one of the stakeholders. But the principle is that India, and this will become out in our presentation, is an extremely dynamic and interesting market for everyone. However, it needs to be approached with a mid/long-term perspective. And not always Italian and Indian companies are able to assume all the burden of such kind of investment. Consider that we mainly, not exclusively, but mainly work with SMEs. And typically an Italian SME needs to have and to bring home quickly some results. The word quickly and starting working with India, besides some very happy exceptions that don't go along together very well. India needs to be approached, as I said, with a particular perspective. Typically, Italian small and medium-sized companies do not have the resources, not so much in terms of economic resources, but also in terms of human resources or ability to strategize for the Indian market in such a way to minimize the time investment to approach and to start operations in the Indian market. But I will get to that in a few minutes. In our survey, which is, as you can imagine, an ongoing process because number of companies being established in India is increasing. We actually witnessed towards the last quarter of last financial year, so between September to December of 2019, a surge of interest from the Italian side towards the Indian market. with an increasing number of new companies being incorporated in India, either as JVs or as project office or as subsidiaries in India. All of this interest obviously got completely stopped by the present crisis, but we foresee somehow, in our perspective, at least for the last quarter of calendar year 2020, so between September and December 2020, a slight and a slow resumption of the possibility of people traveling from Italy to India to continue what was initiated almost one year ago. In our exercise, we have mapped a presence of approximately 685 Italian investments in India, again, in forms of either JVs or 100% subsidiaries of Italian companies in India. The highest concentration of this presence, as it can be imagined, is in the western area of the country. Mumbai, Pune, but also Gujarat have the highest amount of Italian investments, followed by the NCR region and Delhi, then Bangalore and Chennai, so south and southeast of the country, with a much smaller presence in the northeast area of the country. The total stock of investment from Italy into India is in the tune of 6.5 billion euros. Next slide, please. The kind of investments are the ones typical of Italian manufacturing prowess. So at the first, approximately 20% of Italian investments in India are with regards to machinery and equipment. We are talking about heavy industries, but also machine tools, material processing machinery, so wood processing, stone processing, plastic, rubber, metal processing machinery. Automotive is, again, another big sector in which Italian companies are present. Infrastructure, construction, and technology as well is one of the main areas, followed by fashion and design, so company sourcing from India and working with international and global brands. And agro-industry is another sector of relevance for our investments in the country. Next slide, please. So the next slide identifies what are the plus and the minus points that somehow push Italian companies to consider India as a destination market for their investment, and what are the minus points that somehow slow down the decision in initiating operating in the Indian market. The advantages are fairly known and generic, it's not specific for Italian companies. The demographics and the very low average age of the Indian population is definitely one element of great interest for Italian and international companies. Besides the hopefully contingent crisis, the Indian economy remains a fairly dynamic and a growing one. The domestic market is extremely wide, even though it's extremely diversified also internally. Politically, from the governmental point of view, there is recognized stability in the succession of the various governments. There is also raising position and ranking of India in the global competitiveness indexes, even though there are still some areas in which there is a dire need for improvement. It is basic, to some extent, a liberalized market where 100% FDI, but some sectors is allowed in almost all the sector categories. Labor is relatively still low, even though I personally think this is an advantage only to a certain extent, and this is somehow related with some of the points that I have highlighted in the disadvantages. And there are some financial investment opportunities in different sectors. Now, the disadvantages instead have some elements which are specific to Italy. We like to call the Indian market a high maintenance market. India needs to be approached with a very specific and I would say dedicated strategy. Too many often Italian companies, I talk about Italy because this is my field of action obviously, even mid caps and big companies think of the Indian market as typically as the Chinese market, but in some cases also to other European markets, which is a big mistake. It is very difficult, and it is a very strong limit for Italian investments in India to have experienced or capable manager open and available to look at moving into India. Antonio might correct me on that because this is an element of the regular discussion between the two of us, but the very few Indo-Italian joint ventures that work well, even Indian subsidiaries of Italian companies, but especially with joint ventures, are those in which there is a regular presence of experienced and a dynamic and an open-minded Italian professional coming from Italy who's able somehow to understand the specific needs of the Indian way of doing business, on the Indian intricacies of manufacturing, especially when we talk about manufacturing areas which are not in urban centers but in almost rural areas. All these complexities need somehow an openness and preparedness of mind by Italian managers with a certain experience, which are able somehow to also translate into the operations of the Indian companies what are the values and the standards that the Italian companies need to maintain whilst operating in the Indian market. This is why somehow it is also related to the point of quality of life. There are very few Italian export managers or managers willing to move into India. It's far lower the presence of Italian nationals as compared to the German ones or as compared to the French one, which are moving with their families into India for a period of at least 3 to 5 years to start up operations on new companies in the country. Another area which we have identified as particularly disadvantageous for foreign investments in the country is the high custom duties that are still applied for capital goods and innovative technologies which are not yet present in the Indian market. We know very well that the latest narration of the Indian government is to be vocal about local. No doubt that this, considering the current scenario, this has a reason and can be easily explained. It is equally true that if you want to be able to manufacture, to cater not only to the local and to domestic market, but to be able in the future to cater also to neighboring market or to re-export to Western and European countries, you need to be able to facilitate the introduction of new technologies and especially know-how. Another element which is particularly critical and which has been highlighted several times by our members, so Italian companies with a presence in the Indian market, is human resources management, which is not just related to labor laws, which are somehow continuously changing and do not give a long-term and long period perspective for the Italian investments in India to adapt to a clear-cut regulatory framework, but it is also, and especially I would say, related to two elements. Talent retention, the mobility, the labor mobility and the professionals mobility in India is very high, and it is very difficult for Italian companies or for the Indo-Italian Chamber of Commerce for that matter to retain the talent. And on the second level, it is availability of skilled labor. Skill development and Make in India are two elements, along with availability of technology, are the three elements that, according, and this is my personal opinion, will somehow define the success and the position of the Indian economy in the global scenario in the next 3 to 5 years. I would not elaborate much longer on my slides. The following slides have some summary of the presence of the Italian companies with some opportunities and criticalities in different sectors. These slides will be made available, I suppose, at the end of the webinar, but are also available directly on our website. Thank you.
Tanveer, we can.
Yeah, thank you. Good evening, everyone. So my flow of presentation would be first discussing the investment landscape in India, then what is the impact of COVID on businesses in India, and then I would like to spend more time on key considerations in a transactions. I think I've got a limited time now. Let's go to the next slide, please. Yes, FDI in India. So you can see around $470 billion FDI has come in India in last 2 decades. Out of this, $115 billion is from European countries in last 20 years. Netherlands is the tax haven, so that's why you can see around major FDI from Netherlands. So major sectors in which FDI has been received is service sectors, computer software and hardware, and telecommunications. Next slide, please. This slide talks about European M&A in India. So out of $31 billion of FDI from European companies, $12 billion is on account of M&A. Materials segment was the major one, contributing to 53%. You can see the ArcelorMittal and Nippon Steel deal, due to which you can see materials is the highest contributor to the M&A activity. Other sectors like power, cement, steel, you could see M&A transactions because these sectors wanted to deleverage their balance sheets. In information technology, M&A is happening to acquire customers, to acquire talent and advanced technologies. In industrial, it includes infrastructural M&A, and in that investments are happening in transportation, electrical equipment and machinery. Next slide, please. So this is a poll question which I request all the attendees to take. The question is, what is estimated time in which your company may recover from the pandemic's impact and achieve normalcy? The options are short term 6 to 12 months, mid term up to 2 years, long term more than 2 years, and no significant impact. So we'll now discuss the COVID impact on businesses and how it has impacted the sectors. So you can see the result. Short term is around 6 to 12 months is 52%. It's highest. Let us see in next slides. Yeah, so the impact of COVID was, India had lockdown in March, March and April, and during the May. There were several issues both at business level. Most of the businesses operations had to shut down. There were no protocols to manage such type of pandemic. There were issues in terms of engaging the labor because labor migrated, and when the businesses were started, it was difficult to estimate what is the demand, how much is to be manufactured and produced, and how to bring back the workforce. There was changes in customer preferences. Now the consumer has been really thinking what to buy, where to buy, when to buy. These type of changing customer preferences has changed the way business has to be managed now. Liquidity crisis were there. There was a cash crunch. Still, people are trying to see how to raise the funds. Operations and supply chain were yeah, they are trying to find alternates from where to which is a better way to procure raw materials. They're trying to discuss with suppliers what are the stress points. In terms of M&A, there is a fluctuations in investors' sentiments. They are trying to, investors would really want to wait and see, and may not want to put the entire cash at one time. They would want to, they are looking for more aggressive price reduction mechanisms, broader reps and warranties, more favorable indemnity arrangements. So these are some of the arrangements which investors are trying to negotiate with the seller. In terms of sectoral impact, you can see there are various segments and sectors. The impact could be longer. For example, aviation and tourism, we see the impact could be more. The financial sector, particularly the banking sector, what has happened is the government has come up with some measures to defer the repayment of loans and interest. So there is a high possibility of rising non-performing assets in their books, which will take a longer time to return to normalcy. Some sectors like IT and telecommunications had a short-term impact going forward. So because of this pandemic, the government has come up with certain measures. They have come up with a 10% of GDP of India. They have come up with some, monetary measures. What are the emerging opportunities? Because of this pandemic, there would be a lot of restructuring opportunities like mergers and acquisitions within the companies. They want to consolidate the business. They can utilize the tax benefits if you merge the loss-making entity with the profit-making entity. Some businesses want funds. They want to raise the funds. So they are looking to for investment opportunities in their companies. Cash consolidations can happen if some companies are having cash balance. They can utilize to acquire companies in emerging, from the emerging sectors. For example, the dividend distribution tax has been abolished from 1st April 2020. So it becomes easier for foreign companies to Indian companies to repatriate cash in the form of dividend if the investor is a foreign investor. Technology collaborations, I think this already there were transactions happening in this sector, but because of this pandemic, I think it has fueled more, and we foresee that this is the area where we could see a lot of M&A happening. Just for example, healthcare technology. Now that doctors are available on phone or on video conferencing, drugs are available to the consumer on at home. Such type of artificial intelligence and technologies are being applied, so investments could happen in those sectors. Retail is one of the sectors where we see both positive and negative impact because of the changing customer preferences. We see a lot of investments happening in online retail. Yeah, next slide, please. So there is a poll question which is coming. What is the most favorable route for foreign investor to enter into Indian market? The options are joint venture, 100% acquisitions, contract manufacturing, and greenfield setup. Can we go on next slide, please? So the answer seems to be joint venture with Indian partner. I think let us see what are the pros and cons of under each of these option. So if you see once you have decided, once the foreign investor has decided to enter into India, there are many ways in which they can enter. Contractual JV agreement could be through supply distribution agreement or contract manufacturing or licensing, equity joint venture, and wholly owned subsidiary and greenfield. So these are the options, but every option has pros and cons, because in case of contractual JV, you can enter the Indian market faster, but the startup costs are lower. You should also evaluate what is the intellectual property risk, because you need to share this risk in contract manufacturing. There you need to share the formula or licensing, so there is a higher risk, but it will be a lower risk in terms of when there is a wholly owned subsidiary or greenfield. In terms of control or strategy, I think there is a higher control when you go for a greenfield or a subsidiary setup. Next slide, please. So typically this is a transaction life cycle where any investor wants to acquire or do a due diligence. So these are some of the areas where I will touch base upon: valuation, due diligence, negotiations, and deal documentations. Next slide. So one of the important things when you are doing a joint venture is to understand your partner, because you are going to work together with him. So there has to be alignment of goals. There has to be a proper business plan we need to prepare. So just to let you know, from my past experience, we have noticed that the business both the partners don't draw up detailed business plan, which is very important to understand what are the returns, what are the risks involved going forward, because otherwise after a few years they don't plan, and the joint venture will break. Business cultures has to be aligned. Organizational compatibility is important. We need to see whether in future the joint venture partners can raise financial resources, whether they are operational savvy. I think the most important is trust, without which it's very difficult to take the joint venture to a long term. Next slide. So structural concerns. Whenever a foreign investor is investing into India, you need to see which is a favorable jurisdictions, because normally the tax havens are Netherlands, Mauritius, and Singapore. Now I think Mauritius and Singapore are no more the favorable tax havens, because there was an amendment to the tax treaties. You can infuse funds via debt or equity, but just to let you know, there are certain regulations governing debt and equity. Entity structure: when you select a type of entity, you need to be careful with the tax aspects, and how flexible is to manage through the entity, how easy is it to exit the business. And funds can be repatriated through dividend, royalty, or tech fees for technical matters. Next, please. So one more poll question, what would be the major impediment for investors evaluating deals in the current scenario? Options are elongated execution timelines, uncertainty on valuations and performance indicators, limitations on site evaluation, and focus on core operations. Can we have the answer, please? So I think uncertainty on valuation and performance indicators is 41%, and we are going to discuss why these parameters are very important in the next slide. So valuation and due diligence, it's very important to understand the transaction scope. What are the assets which are going to come into the joint venture? What is the territory we are going to cover? Any products which we are going to hive off? What is the contribution of partners, both monetary and non-monetary? So these things are very important before arriving at valuations. What is a desired shareholding? Because this desired shareholding also depends upon what stake you want and what contributions you have brought to the joint venture. Historical and forecast performance is very crucial, particularly after this COVID situation. You need to understand what will be the impact on revenues, operational cost going forward, what will be the normalized working capital, what is the normalized earnings. These things are very important. What will be the impact on account of increased cost of capital? Such things should be considered and evaluated. After that, you can come to the valuation methodology, which can be there are different methods: asset purchase method, comparable method, market approach method, or discounted cash flow method. I think discounted cash flow method will be most possibly the preferred basis for a determination. But these are the due diligences which one should do while investing into India: financial, tax, information technology, legal, commercial. Integrity is very important to understand the background of the partners, HR and environmental. Next slide. So whatever due diligence outcomes which have come, we need to address those. We need to protect such risk. We can protect by way of in the following manner. So there is a negotiated value which we have arrived, and such values we can adjust through purchase price adjustments, or we can pay over a period of time through payment mechanisms, and we can mitigate such risk by making provisions in the definitive agreement. So such type of arrangements can be done, and you can then when you close the deal, you can decide what is the final outflow to the seller. Now I think I will hand it over to Thomas, who can discuss on deal documentations.
Yes, thank you very much. Good evening, everyone. Good day. Thanks for having me. Special thanks to my Italian friends who invited German to talk about Europe. In the next 15 minutes, I will cover, if you go to the first slide, I will cover some of the typical issues and solutions in a cross-border investment scenario of a European investor investing directly into an Indian company, and I will focus on a joint venture scenario. This representation is a tall order because there is no such thing as a typical European investor, because Europe has big differences. But in general, India is looked at from a European perspective as a very interesting target, both for trade and investments, direct investments. And therefore, I would like to discuss the contents as Tanvir elaborated, of the typical agreements, and I will focus on the terms and the term sheet and the final agreements. And the typical question that every lawyer and investor will ask is what can possibly go wrong in an investment? And how do I get out of the investment? What is the exit route without losing too much money? But we want to prevent, of course, also in the interest of our clients, that from happening. And it's important that we consider everything which is possible to happen in the course of due diligence in a later joint venture investment. And as Tanvi mentioned it, it's important to know your client and building trust, as you said, as you elaborated, and the due diligence will help. Of course, there's a personal aspect to that where people actually have to meet. Unfortunately, that is not possible at this point of time because of the pandemic, but yet in our experience, every M&A transaction that has started is continuing, whereby the meetings not happening, and of course the speed of the M&A transaction is slowing down. But it's important to notice that the interest from a foreign investor point of view into India is very high. So, however, as Claudia pointed out, also we can confirm that India is perceived to be complicated unless you know exactly how it works. It's difficult to understand the legal system, the tax system, the operations of transfer of money in, transfer of money out, etc. So I will ponder on that a little bit, and also finally talk a little bit about what is to be avoided for joint ventures, so that could cause a failure of the joint venture. In most cases, these are not legal aspects, but more cultural aspects that cause joint venture to fail. On this slide, you can see some of the major aspects that I've covered. So from a legal perspective, I would focus on things like which law is applicable. Of course, in general, we can say typically Indian law would be applicable in the sense that an investment in India would be only best executed on Indian law rather than foreign law, and whereby you have to understand that the foreign investor who knows their own legal system and their own culture best would have different expectations in terms of closing the agreements. For example, typical questions would be, does the company actually exist? That sounds absurd, but some companies have not actually made everything to establish, to incorporate the company and to have the board resolutions and registrations, etc. in place. Does the asset exist that is part of the company sale? Is the machine actually owned? Is the real estate actually owned by the company or not? Now there are different systems of proving ownership compared between Europe and India. There is no such registration of property like you have often in European countries for example, real estate, where you can simply have a look and then have a proof, but there's part of due diligence, extra due diligence that you have to do in India to actually prove property, etc. So these are just some examples, and I will now move on to the next slide, where we talk a little bit about the term sheet. And the term sheet, when you choose between, and there are different speeds, as I mentioned. The foreign investor would like to get control over their investments as soon as possible. And there would be a typical expectation of having at least 26% of shares in a company, because that is a controlling minority, or not a controlling, it's a minority which allows the foreign investor to actually exercise control over the company. and the Indian seller would typically have, let's say, the interest to extend the term. And there seems to be a paradox because India, compared to many European countries, is moving very fast. So the development of the business is moving very fast. However, the agreements can take longer period of time. And I had recently a case whereby we started a due diligence, and the sellers would hold up a USB stick and say, well, we have the entire due diligence papers and the due diligence files on this stick, and we should be done in 1 week. And then we have a closing agreement. So unfortunately, after 3 months, we were still in due diligence and we were still asking questions. So it's all about expectations and settlement on different expectations and come to a fair solution, an agreement. And therefore, there are typically 2 sets of agreements. One is the term sheet, which is more commercial agreement, which outlines the major commercial parameters or the legal parameters of the deal, of the transaction. And then later on, the definite or the final agreement, for example, share purchase agreement, joint venture agreement, which I come as the next point. So, but we stick to this one first. First of all, question would be, of course, what is the purpose of the joint venture? What is the objective? And that sounds obvious, but it's not that obvious very often to actually agree what are the responsibilities, what is the purpose of the joint venture, what are the aspects of success, and what are the criteria of success, and what are the responsibilities of each shareholder. Without that agreement, you cannot go further, because for sure, if one shareholder says, okay, I've got the money now, I sit back and do nothing, then you will have a failure right away. And we have seen that, unfortunately, often happening in foreign investments, that the foreign investor went in. There was expectation on the Indian seller or joint venture partner, and more often than none, the Indian joint venture partner has done almost nothing in the perception of the foreign investor, and therefore the foreign investor has terminated the joint venture agreement again. So that's the very first question, obvious but very important. And that also covers, of course, the financial contributions and the ownership, the shareholding, be it in cash or be it in lieu of cash, in terms of, for example, knowledge transfer, licenses, etc., or services, shared services, or whatever may be in consideration of payment. Then I don't want to drill down on valuation again. Tanvir has done that in great detail. That is important to agree on, and how to finance the deal. And we have quite detailed Indian regulations that regulate and restrict still investments into India in certain industries. It has relaxed, but very often you can see the requests. For example, I can think of Tesla a couple of years ago, which was interested to set up business in India, and they told us that they are not interested as long as they cannot hold 100% immediately. But that's now possible, so there's a lot of lot less restrictions than it used to be now. But still, from a foreign investor point of view, it could be even less restricted in terms of transfer of capital, especially out of India, in an exit scenario, or even in a normal scenario of dividends repatriation. And the financing is also restricted by the so-called ECB regulations, whereby a foreign investor has to hold a minimum of 25% of an Indian company to be able to actually finance that company in terms of a shareholder loan, for example, or other finance. And all that needs to be considered when you go in and agree on the term sheet. And finally, how do we protect the interests of the minority shareholder? Typically, the foreign investor will take a minority share only, even though they are looking to hold a minimum of 26%. That is to be controlled, and the intellectual property that may go into the company, into the Indian company, either immediately over a period of time in terms of training people, setting up operations, setting up new procedures in production, etc. Either on a license basis or on a payment basis. We move on to the next slide, please, where we see we talk a little bit about the definitive agreements. And the definitive agreements, meaning in this case share purchase agreement and joint venture agreement, which typically comes as a 100-page package with plus amendments that the shareholders typically not read by themselves but by the lawyers, but it's still important. That obviously follows the terms, the term sheet that have been agreed previously. And we have around, this is the most important part is, of course, how do we manage and how do we control the company? What is the governance model, management and control? And this is, you can see that in the middle of this slide, operations of the joint venture. Typically, the shareholder pattern in the joint venture company plays a major role in its control and management because the share or the management follows the shareholding. Basically, you have only a certain number of director seats, and the question is how many seats do you get, and what is the vote, what is the quorum and the vote of the shareholder that can decide over the matters of the company. And how many director positions does the new shareholder, the foreign investor, get? You know, questions about shareholder meetings and shareholder rights. So I would like to discuss just two main points on the shareholder rights. There's difference. There are two different rights: statutory rights and the contractual rights. Obviously, the statutory rights governed by the Companies Act would always take preference over the contractual rights that the shareholders can agree upon. But still, the statutory from the statutory perspective, any matter to be decided on shareholders still can be focusing on the so-called ordinary matters or special matters. And ordinary matters requires the consent of at least a simple majority, and the special matter requires consent of at least 75%, which is why the foreign investor wants to hold 25% plus to be able to actually participate at least, or to take control over the governance of the company. So I would like to, because of I look at the watch, because we don't have much time left, would like to keep some time also for questions and answers, and stop here. We would just briefly touch on the questions of termination and dispute resolution. It's important to know for the term and termination, you know, what happens before we actually terminate. What are the incidents that allow termination? What happens with the assets? Can they be returned? At what price, etc.? All this needs to be in agreement. And of course, the dispute resolution. Typically, you have arbitration. You don't want to be in court in India, and when you agree on arbitration, you need to know what is the best place of arbitration. Is it India or is it outside India? You need to know, for example, that arbitration in Dubai would not allow you to execute, to enforce arbitration judgment in India if it's done in Dubai, etc. So the international law aspect is as important as the international tax aspect. and of course then any practical matters with regards to the communication between the two partners, the different reasons that may arise for the joint venture to fail, is, as I said before, in our experience, not just on the legal aspects, but the majority being on the cultural aspects, and therefore it makes sense to spend more time in the beginning to get to know each other and to understand what to be expected from the joint venture partner, and then to live it, rather than having a dispute at the later time and then lose money. Thank you very much. I would hand it back to the organizer, and happy to answer any questions that you may have.
Yeah. May I say something? Okay, I take the word. So I want to add a couple of points of my experience. I think that I mean, my let's say fellow panelists as well, everyone is saying very relevant point. Thomas, I agree with you that basically what I want to say is that according to me, my experience, is that complications that we are discussing, very honestly, I do see them coming from, first of all, from the complexity of the market. I just want to clearly state to European investors and so on, I don't think that my point maybe is required, but here we talk about a federal country which division of competencies from the Delhi government, the union government and the state, and we talk about a sum of markets, and the diversity within the markets are huge in terms of consumer behavior, and also for some sector regulation wise as well. So I would say that as a main point, this is not like you know, a normal market, but this is a real continent with lots of different markets within, in a situation where honestly in the last 10 years we have seen relevant actions from the government to, you know, like channel the diversity of the local markets in one big market. I mean, I don't want to say only the GST reform, which I do think is the first and the most important one, but we've been seeing an alignment on the regulation as well as like from the policymaker side, let's say. But there is a complexity. You were talking about also like when you do an M&A, then there is always most of the time the need of evaluating or have an evaluation of the real estate assets. We do have some experience. I had indeed some experience in the past where we were buying out a company here in India, and the factory, for example, was constructed on land which was owned not by the owners or the company, but it was owned by a particular entity, which I do think is existing only in India, the HUF, which is the undivided Hindu undivided family, because basically the entire family manage as its own entity, like the ownership, which creates you a problem, because if then you build the factory on them, and then there's a company which wants to buy a company with the factory, then there's a problem also of the title search and the transfer of the ownership, which is not in the hands of one person, but also an entity which has different rules. Title search in terms of real estate, honestly, I do think that are very complicated in India. I've seen teams of lawyers, I mean, anyhow, like to, you know, like verify the ownership of a land of like an immovable property, despite some of the main cities where, you know, the register, local register are online, there are problems over there. Most of them are not still, let's say, in the electronic form. So very honestly, despite the fact that we can do great transactions with a huge amount of money involved and so on, you may have like lawyers which they sit in the room of the register for days because they need to go page by page on all the title search to verify it, and then come back to you saying that yes, you want to buy the company, the land on which the company is built is indeed owned by the company itself. So indeed there are lots of, let's say, I do see complexity in the transactions, which requires time and focus. So I do think it's a very much matter of focus and also matter of involvement. I will say that whoever lives and work in India, I would say that after few years you start feeling like comfortable in this challenging environment, but there is a gap to bridge, very honestly. And I do advise whoever is looking at transaction in India to either try to be involved in the reality, or of course make it happen that things are not under control, because the laws and also with the new reforms and so on, honestly, I don't think that they are quite similar to within the world of common law, but the enforcement of the law is a problem in India. So again, it's not only a matter of writing the right contract, but it's a matter of really making sure that the contract is alive among the parties, which basically means that as a controlling party, honestly, it's not only a matter of the contract, but you need to have your own people, you need to lead the processes. So all of this goes back to really like most of the points said when we build up like an M&A, let's say, transaction. And the first step that Thomas or Claudio also to me was saying. So just this was an experience from my side of different transactions in the past years. I do think that it's a great opportunity. The market is, despite the COVID, is having, according to me, like good opportunities. But we need to really like undertake each and every opportunity with the calm and the analysis which are required. Thank you. Now the Q&A session. Now I leave the word to the organizer.
Thank you to all the speakers for their presentation. We now invite all of you to type your questions in the chat box in the webinar panel for our speakers to answer. We shall take up some questions now. So one of the questions is, what are the restructuring plans and opportunities for European companies in India? Antonio and Claudio, would you like to answer this?
Okay. See, restructuring plans. I think that we talk about European companies which needs to restructuring their activities over here in India. Again, I mean, I don't want to become technical, but restructuring plans it's something which it's an activity, it's an ongoing activities most of the time over here. You have a challenging, change scenario. I actually don't know how to take this question on the legal side, on the market side, or wherever. My personal experience in dealing with the restructuring plans in India is that honestly, you have a relatively more flexible environment compared to Europe, or I would say like few European markets that I have experience on. In terms of really like having like your restructuring, which can really bring on a plan to, I don't know, assess another market, restructuring your workforce or investments and so on. I've been actually seeing quite a high level of flexibility, because nowadays, in terms of companies, if you are in manufacturing, you can easily also have different contract manufacturing work. So you can, as a company, decide to outsource part of the production, or at the same time internalize, but without like a direct investment as well. I will actually ask the whoever make the question to be a bit more specific in order for me to give some maybe more details. As a matter of a generic question, I do see quite a favorable environment for restructuring plans due to the fact that there is indeed some like flexibility on the labor side, and also the new regulation leave companies quite free to remap their business and restructure accordingly then their companies. In terms of opportunities, there are lots of opportunities. Again, we should talk about the single sector. Normally, sectors have the valuations are of assets over here, like localized. Let's say they have different multiples. We should talk about actually the single sectors to evaluate opportunities. My personal point of view is that I do see indeed lots of opportunities, even in this emergency time, because it's a time where companies are, it's this time of disruption. So definitely there are opportunities to catch. Claudio, you want to add something?
Yes, on the tune of what you were saying within the current scenario and the current context of the pandemic. Digitization has been one of the key elements that all the companies worldwide, be it manufacturing or service companies, have to cope with. India is no exception. Most of our members, Italian companies in India, especially those in the service sectors, have to somehow push or accelerate on the business model adaptations towards digitization on one side. Manufacturing companies instead, which somehow have tend to have a more traditional kind of setup as far as operations are concerned, but indeed remote working is becoming a new need of the day, which Italian companies in India, Indian companies in India for that matter, and every company globally has to adapt to, and this is something that we see is happening already right now in India.
Thank you, Antonio and Claudio, for the response. Since we are running short of time, we will just take up one last question. We would answer all the other questions via email. So the last question is, what are the sentiments of German and European companies towards the Indian market currently in light of the pandemic and ongoing discussion between India and EU? Tanveer and Thomas, perhaps you could answer this.
Yeah, shall I go first? Between EU and India, we are missing the long-awaited free trade agreement, first of all, which Mr. Modi has promised and Ms. Merkel is waiting for. Typically, invest follows trade, so that would be helpful to at least get something moving again. Also, there's an imbalance at the moment between foreign investments into India and Indian investments into foreign countries, definitely into all European countries. So there's probably a ratio of at least 4 to 1, if not more, depending on which country you're looking at, with the exception of the Netherlands that you've mentioned, because many investors go through a vehicle in the Netherlands for tax reasons, as Tanveer mentioned it before. But the sentiment is positive because of the, as you know, global trade changes that are happening, where China, US, and Brexit, meaning India clearly becoming more than before even an alternative to China as a partner for trading, but more so for invest. With potentially higher returns on investment than you can get in Europe, both for the knowledge transfer into India and the joint venture that way, and to make in India as a bench for European investors, European companies, but more so also for the large Indian consumer market that's interesting. So I think from a German perspective, and probably for most of the countries that have been mentioned, in definitely Italy and France and other European countries, very positive from my experience. Despite despite the problems, the perceived problems with the regulations and the paperwork that you have to do if you do business in India.
Correct.
Okay, so we
there are
have
barriers.
just
There are entry barriers, so it's okay. I mean, we keep the bar high. So
If
okay, so
I
we
may
have
add
just
to that, sorry, very quickly. Indeed, one of the major areas of discussion between India and the EU is whatever is related to green economy, circular economy, sustainability. You know that Europe has terrific know-how in those areas. India has a dire need of acquiring skills and being able to adapt some of the European experiences to the local needs, to the local environment and context. So that is an area in which renewable energies, think about that. In the next 5 to 10 years, I think and I believe there will be a huge traction on the axis between India and the EU. With regard to the free trade agreement, Thomas, I arrived in India in April 2007, and they started talking about the free trade agreement at that time. So it goes back.
I know.
At least 4 governments ago, at least. Sorry, Tandir, you wanted to say something.
If I may, on this, being in the EBG, European Business Group, we normally have our boards with the delegation or one of the diplomats from the EU delegation in Delhi, and we've been always having like the update. So I've been following up, you know, the story on the agreement between India and EU. My personal point of view is that now maybe we have more chance because of the global scenario to come closer, which is my sincere hope as well. Because I mean, for the way that the globally, like the geopolitical games are shaping around, I do see the need of the EU and India to come closer. I always been thinking about perfect, let's say, partners, but it's quite a negotiation, because it goes from consumer product to industrial and IP and so on. We also needed the investment protection, which basically was, I think last year they chased all the contract, and now it has to be done on the European level as well. So things are there. I do hope that with the current situation of I would say relatively problems between India and China, which gives also an additional push, you know, like to finalize an agreement with between India and the EU. Thank you.
thank you so much, Antonio, Claudio, Tanvir, and Thomas, for taking out the time to share your valuable insights with us. We hope that the insights shared by our speakers have been useful for all of our listeners. Thank you once again, everyone, for joining in, and have a nice day.
Thank you.
Thank you, everyone. Thank you. Thanks a lot. Bye.
Thank you, everyone. Thanks. Bye.